Good afternoon, everyone. Welcome, and thank you all for accepting the invitation of OTP Bank, this webinar on global and local markets. It's already the second one this year. My name is Alexandru Angel, and once again, I will present this event. So, today, during this webinar, we will approach the current economic status and context, and also future prospects by sharing important macroeconomic insights with you, and taking into consideration how these recent geopolitical developments have impacted the markets. But before we begin, I have a few housekeeping notes, let's say. Today's sessions will be recorded. All speeches and presentations today will be also held in English. But of course, translation is being provided. For Romanian, please press the button translation below. Please keep your microphones on mute during the event, but your cameras on so we can see each other. So if you have any questions for the presenters, also please use the chat feature and post the questions right there. So after that, in the Q&A session, we'll be able to answer. And also please mention which presenter you're addressing for your question. So if everybody hears me, I'm going further and I'm gonna introduce the keynote speakers. So here with us is Gyula Fater, the CEO of OTP Bank Romania. Then Gheorghe Litardos, the Chief Economist, Head Economist of OTP Bank Research Center. Mihaly Kovac, Economic Advisor at OTP Bank's Research Center. So now, let me please introduce the first presenter, Mr. Gyula Fater, CEO of OTP Bank Romania. Sir, you have the floor.
Thank you for the introduction, Alex. And thank you, dear partners, for accepting our invitation and joining at the second webinar this year. Our aim is to provide with you accurate data and continue to be a relevant source of information for you. The main objective is to help you to dive into the macroeconomic words, to be in control of the information, to better understand today's context, so you correctly anticipate the future. What we offer you is the right leverage to stay in balance, perform, and expand. OTP Bank is an international financing group with excellent research capabilities. And today, together with you and my colleagues, we will explore familiar and less familiar financial and macroeconomic topics. As it is in the business, we all know the importance of having a stable partner by your side. And we at OTP Bank, we are committed with all our international know-how in supporting your developments. Here in Romania, OTP Bank is already in the second part of its 5-year growth program and far ahead its business objectives for this first milestone. Since the implementation of our growth strategy 4 years ago, we came along a long way. We implemented and diversified our products and service portfolio. We already developed new and relevant products for you. We opened up new channels. We maintained investment flow in digitalization. However, I must admit that we still believe that the most important part of the interaction is the human part. So we believe now more than ever that the most important element of any business relationship is the human part. We can all see that so far this year has proven to be even more difficult than what we have seen in the last 2 years. From a different perspective, starting with the concerns regarding the evolution of inflation, which is much more acute and persistent than we expected. And I only can keep my hopes high on finding the right tools to transform these threats into opportunities in the future. However, I trust the market, I trust the people and the government, moreover, the financial sector and the institutions to be prepared for this challenge and bring us and to you the necessary resources. Today, during the second webinar, my colleagues have prepared all the necessary details in this regard, and I will be also available to answer your questions at the end of this session. So let's start. Thank you.
Well, thank you for this words, Mr. Fatar. A lot of progress in the last years, and also a lot of new challenges. This one. Let's see what we're gonna see about these few months. What are you going to expect, sir? If you wish to.
Mishi, or Mihai, now I can see not the presentation shared, but some other documents.
But actually there must be a delay because I'm sharing the presentation itself.
Yeah, the presentation is on. We can proceed.
Maybe there is some problem with my Zoom, but okay. Let me start. On the first side, you can see our main forecast for the Romanian economy, and the most important takeaways are the followings. So despite the very strong GDP growth in the first quarter, which was surprisingly strong for us, we think that looking ahead, growth will slow down during this year and next. And this slowdown will be driven by three main factors. First, inflation is really high, and that erodes real incomes, and this will be a drag on consumption.
Sorry, let me interrupt you just for a second. Please have a share of on the presentation again. Yeah. Yeah, can you? Okay. That's perfect. We can go on now. Thank you.
Okay. This slowdown will be driven by three main factors. First, high inflation erodes real income, and this will be a drag on consumption. Second, we expect a tighter policy environment. First, after some reversal in fiscal consolidation this year, we expect fiscal policy to tighten next year as the deficit has to be reduced looking ahead to mitigate the financing and the stability risk on Romania. Second, the central bank should also increase rates in order to fight inflation. And it's also very important that the war started in Ukraine means strong headwinds to exports, and this will be also a factor which moderates economic growth looking ahead. Inflation rose really fast, not only in Romania, but in most economies of the world. In Romania, it hit 15%, and looking ahead, we expect inflation to remain in the double-digit territory until next spring. But we hope that the peak could be close now. As I mentioned, that further rate hikes looks to be unavoidable. We expect the central bank to accelerate monetary tightening, and we expect the base rate to reach 7% by the end of the year. And finally, on loan growth. Loan growth was very strong last year, especially in the corporate segment. The last data in April still shows decent growth in most loan segments. Nevertheless, the first signs of weaker loan growth already materialized. So we think that lower economic growth and higher rates will gradually drive down loan growth in the coming months and quarters. Regarding the global economy, the picture deteriorates really fast. At the beginning of this year, the developed economies let's say that the outlook was really promising. The rebound last year was very strong. Nevertheless, soaring energy and food prices, and later the war started in Ukraine, made this outlook much more gloomy. In the first quarter, developed economies showed, let's say, still okay growth rates. They showed some slowdown, especially in the US, but we can say that a general slowdown has not been materialized yet. But looking ahead, higher energy prices and higher inflation means a serious risk for the global economy. Both in the US and in the Eurozone, inflation rose much faster than expected, and the peak could be reached at higher levels and later in time. In May, both economies delivered higher than expected inflation, and this resulted in a general increase in rate hiking expectations, especially that even on the short run, repricing activity remains strong, and this resulted in a total change in the monetary policy outlook in developed economies. In the US, the Fed is expected to hike rates to 4% very soon, and actually the Fed delivered a 70 bips hike on its last rate-setting meeting. And in the Eurozone, the ECB is expected to hike rates at least to 2.5% soon. And these rates are something like 100 basis points higher than what we had only a month ago. And higher rates means lower loan origination, lower equity prices, and this can put pressure on growth in advanced economies. It's also important that long-term yields rose really sharp and reach levels not seen for many, many years. So the global outlook became weaker. It's very clear that developed economies will slow down relatively fast during this year, also because of high inflation and tighter monetary policy and supply chain bottlenecks, and there are many tail risks regarding the war in Ukraine. And it's also important that not only growth outlook weakened, but also recession risk rose, and the probability of a recession in the developed economies increased seriously from normal levels to, let's say, to 30–40% by now. And it's also very important that while expectations on inflation are relatively optimistic, and says that within 1 year, inflation in developed economies could decrease really fast toward back to the inflation target, the risk is clearly on the upside. Partly because of still high food and energy prices, also because of upward risk and because of tight labor markets, which led wage growth to accelerate or to remain high. And on the middle run, this can put more pressure on prices. So to summarize the global outlook, what we can expect, relatively fast slowdown in economic growth this year and growth to remain modest next year. It's also important that from the current highs, inflation is expected to moderate, and we think that that will happen, but risks are on the upside for a much slower deceleration in inflation. And the monetary policy outlook, that's a clear risk. Central banks, both the Fed and the ECB, will be forced to hike rates, and the big question whether this will drive developed economies into a sharp slowdown or into a recession.
Okay, moving towards the Romanian economy. As partly mentioned that the Q1 GDP for this year was a huge upside surprise. In fact, the story was here that last year how the Romanian GDP looked like, and I would like to draw your attention to the upper chart on the slide, that why the recovery from the COVID crisis up to the midst of last year was very sharp. In the second half of the year, the recovery practically halted. We mentioned it last time as well. And, you know, if one looked at fundamentals, one thing was that the fading away of the Omicron wave could have given some impetus to the Romanian economy as well, but otherwise headwinds were increasing in the form of higher inflation, supply chain problems, etc. Nevertheless, the Q1 GDP figure was 5.2% quarter on quarter. And if you look at the chart, I mean, it's worth to remind that such high growth rates were very rare, apart from the recovery from the COVID collapse in the second half of the year 2020. Otherwise, normal growth rates, even in good times, are closer to 1%, 1.5%. So in this sense, it was a big surprise. And we already have the details of the GDP data. And from the production side, and I would like to highlight the lower chart on the slide, the surprise is practically almost totally to this market, service and trade, this yellow bar. There you can see the components of the sectors to GDP. And there one can observe two effects. On the one hand, this wholesale, retail, trade, and hospitality sector growth was very decent. This was partly led by the recovery from the Omicron wave, and you know, during the pandemic, people were turning towards goods from services. Partly they were forced, partly they were avoiding close contact. And as the pandemic subsided, this situation has turned back, and it turned out stronger than we foresaw. And probably one cannot really confirm this formally, but we think that the Ukrainian refugee inflow might have had also some effect. We think this part of the story, this recovery in the service sector is partly temporary. Nevertheless, there was a very strong growth in the ICT sector as well, which is a bit surprising in the sense that during COVID times, this sector already grew understandably very significantly, but this pace kept on and did not really slow. So this was again a surprise, and it's so far there's no very clear explanation for this. Maybe this trend might continue longer. Nevertheless, looking ahead, we think that while the short-term growth outlook improved, we think that the fundamentals in general, what's shaping the country's future for the next years has not changed. First, we have this double-digit inflation, which is a drag on real wages and consumption. I will speak about the labor market in just the next slide. I will detail it more, but you can understand that from a decent real wage growth to a slowdown to real wage stagnation or decline, that's not helpful for economic activity. Gergely mentioned that we expect a slowing global growth, and some trade effects of the Russia-Ukraine conflict is also visible. So all these factors will bind gradually already this year, while another factor is the policy effects, what was also mentioned by Gergely. On the one hand, fiscal consolidation should restart, which completely stopped in the last half year, as we will discuss in a minute. And also the interest rate environment will continue to rise, which will not helpful for loan origination and economic activity. So on the upper slide, I would draw your attention how the economy performs compared to a pre-COVID trend, which is the black line, and the green line is the GDP level compared to end of 2017. And you can see that it quite approached the COVID level, but looking ahead, we expect some slowdown. This year's growth could be above 4% because despite of weaker next quarters, the first quarter growth was so strong that it will give a very high base for this year's growth. But next year growth will slow below 3%. This is our expectations. You can see it on the lower chart in green. And we are a bit different from the market consensus for Romania, which is the red line, which expects somewhat slower growth this year and more decent growth next year. But we think that this good Q1 performance raises this year's growth. But on the other hand, we are relatively pessimistic in terms of the fundamentals which are shaping the outlook. And the range, you can see the Central and Eastern European country forecast from Bloomberg. I mentioned already the importance of the labor market in terms of the GDP outlook. Here we can state at least two things. On the one hand, the company employment level, you can observe it in the upper chart, has more than recovered from the COVID crisis. You can see that the green line is already exceeding the pre-COVID levels. And there are also, despite of the fact that the survey-based employment is still above COVID levels, there are some indications that in several sub-industry parts, labor market is very, very tight and wage pressure is rising. Rising wage pressure is also partly visible in the statistics, which is on the lower chart. Here, what you can observe that the nominal wages, the black line, which grew around 6-7% until the autumn of last year, has started to increase toward 11% or more in March, April to catch up with high inflation. But, you know, April inflation was already almost 14%, not mentioning the May data. So this still meant that that real wages could not grow, at best stagnate in the last few months. So again, the key question is here, what will happen wages, given the inflationary pressure, worsening real economy outlook and tight labor market. We think that wages will partly adjust further, still slightly upwards, but we think that real wages will hardly grow this year, and this will be a drag on economic growth. Turning to fiscal consolidation, it's important to stop here for a moment because we think that this is one of the key fragilities of the Romanian economy currently, or we can state that the twin deficit problem, which is the simultaneous deficit in the fiscal accounts and the external balance, this is what is considered by foreign investors to be a key risk for Romania. We know that Romania is under the European Commission's excessive deficit procedure, even from the pre-COVID times, but during the COVID crisis, there were some temporary relief from this procedure, but there are two reasons why fiscal accounts should be put in order. First is we have this EDP procedure, but even without the European Commission, the rising financing costs of government debt mean that the fiscal accounts should be put in order. And last year's deficit was above 7% of GDP in Romania, which was already an improvement from the previous year, but not very significantly, as you can see it on the lower chart. And here the important point is what happened in the last few months since we haven't met, is that while from 2020 to 2011, some improvements in the fiscal accounts could have been observed, this tendency has completely halted in the last half year. Here I would draw your attention to the upper chart, where the black line is the so-called ESA-based fiscal balance, which is what the EU considers as relevant and should be below 3% according to the Maastricht criteria. And the other line is basically the cash-based, where we have more timely data, and it indicates that what I just described, that the improvement in the fiscal accounts has stopped in the last half a year. There are plans, we are aware from the government to reduce the budget spending. There were some announcements that the expenditure level will be cut by 10%, but so far how we understood, very important elements will be left out, which then it's hard to see what will be the overall effect on the expenditure side. There are different plans to raise the revenue side, partly along the IMF recommendation, as we understand, like raising the effectiveness of VAT collection, probably introduction of some extra tax on corporates or labor. There are some discussions in this respect between the coalition parties. However, we are not sure that this will have a meaningful improving effect still this year, as we are well in the year end. We expect some slowing growth. On the other hand, the energy costs of supporting the private sector with the energy bill is rising. We had the social package, so we don't expect a decline, a material decline in the deficit this year. We think this deficit decline will more appear next year when you know, the effect of the probably adopted measures will appear, but this is probably will only be gradual as well. And moving towards the other crucial or problematic point of the Romanian economy and the twin deficit problem is the high current account deficit. In fact, the last data from April showed like 7.7% to GDP current account, so almost 8%, which is relatively high even in regional comparison. And it's especially high given the fact that that the energy price effect on Romania's terms of trade or external balance is much more limited than in other countries, like, for example, Hungary or Slovakia or Croatia. We can mention a lot of countries because Romania has its own production in terms of energy. We estimate that the effect of energy price hikes on the current account in Romania is in the range of 1.5% for this year compared to the previous year. So this high current account deficit only very partially reflects the high energy prices, and it to a large extent reflects the high fiscal deficit and the high structural overspending in the economy. And given the temporary stop in fiscal consolidation this year, together with high energy prices, we think that the current account deficit will rise from the previous year 7%, close to 8%, and some normalization will only start next year once the fiscal position starts to improve. So far, this was about the external balances, and turning to the situation with inflation and price outlook. We partly mentioned in the beginning that the inflation level in Romania reached almost 15%. In May, actually, it was 14.5 to be very precise. But you know, in fact, there was a big surprise in the inflation developments in April when this new price cap was introduced, energy price cap for households, which will expire next March. And as it turned out, that based on the accounting of the statistical office, it was considered a much narrower price cap than the previous one. So contrary to the consensus of 11.5% inflation, the April inflation came up much higher, almost at 14%. And then May, there was some further small pickup, but it was already fully in line with the consensus. And it is only important that probably now we understand a bit the developments better. And if you look at the month-on-month dynamics of the data, especially food prices, which were also a significant contributor of inflation in the last half year, let's say, or even more, the month-on-month food prices has started to normalize. So we can hope that the peak could be close. In our forecast now, we project the peak in the next months close to 15%, and a very gradual decline afterwards. And the driving force of inflation from energy and food gradually moved towards core inflation, so less volatile items, where the high wage growth and unit labor cost could cause problems. And additionally, we assume another household energy price increase next April when the current price cap expires. But the bad news from this part is that we cannot foresee single-digit inflation until March next year. So we think inflation will remain in the double-digit range. And naturally, these projections are based on roughly natural gas price levels around 100 and euro per megawatt hour, and oil price is also around 100 US dollar per barrel. So the recent increases, especially in natural gas prices, obviously is a risk to this outlook. Moving further to to the situation with monetary policy, once we saw the inflation developments, Gergely partly mentioned that the global yield environment has changed substantially in the last months, given the US and Eurozone inflation data surprises. And actually this led to a repricing of risks in emerging market very severely. So if you look at the upper charts on the slide, you can see the 10-year government bond yields in the regional comparison. You can see that unfortunately, given its fragility to the twin deficit situation, Romania's yields are the highest and were the highest and remain the highest. So in the last few days, the 10-year government bond yield exceeded 9%, somewhere around 9.3%, which again shows that, you know, the fiscal house should be put in order relatively swiftly. But Romania is not alone in terms of the increase. You can see that all the surrounding countries experience significant long-term bond yield increases. But what is a bit special for Romania, that the yield curve is so-called, to say, it's very steep. So, like Romania has a key rate or reference rate around 3.75% after the latest hike of the National Bank, but the 3-month Robor is already at 6%, and then we have, you know, the long-term yields above 9%. So it suggests that probably the central bank's pace of tightening is a bit lagging behind inflation developments and and the risk premium asked by foreign investors on Romanian assets. So in this sense, we think that the National Bank of Romania will pace up monetary tightening at its next July meeting, probably 200 basis points, and the base rate with a significant pace of tightening could reach 7% by the end of the year, which will bring Romania more in line its interest rate, its monetary policy interest rate, more in line with other economies in the region. Market pricing already suggests 8–9%. Otherwise, the analyst consensus is a bit lagging behind. It's just above 5%. But you know, this consensus figure sometimes, if things change quickly, they can be a bit lagging. And unfortunately, risks still point to the upside. Especially it depends on what will happen with US monetary policy and also with the ECB activity, as we could have observed. Some unfortunate inflation data could yield to a significant repricing of large economy yields as well. And finally, I would speak very shortly about the loan markets. Last time we indicated that that we expect with the weakening economy the loan origination to slow down, and in this up to April, this although we don't have a lot of data since then, but this seems more or less correct. You can see on the right chart that net loan origination, which is new loans minus loan amortization to GDP, which is a good cyclical indicator of banking loan activity, already slowed. Nevertheless, these are decent figures still, and this is also reflected in the fact that on the left side you can see that the year-on-year growth rate of most loan components are growing relatively fast. But from this slowing loan origination, a gradual slowdown is expected in the year-on-year figures after a while as well. We think that the higher interest rate environment and the slowing growth will gradually weaken loan demand. So all in all, this is from our side. I would just jump back to the beginning slide where you can see our main forecasts in the table. On the left side and on the right side, the latest market consensus from Focus Economics, and then I would hand over the floor for questions.
All right. Thank you, Mr. Kovac. Also, thank you, Mr. Cardoș. Seems like a difficult year ahead of us, with inflation peaking in the next few months at 15%. Yes, so we should expect this summer or maybe at the end of the summer to have a 15% peak.
Yeah, in June, actually June, July could be around this level, and then a gradual decline afterwards. This is what we expect.
All right, and that means that with a delay of a few months, also interest rates will go accordingly, right?
Yes, we expect the interest rate to increase until the end of this year to 7%, that stay at that level for a few months. And we think that once the central bank will see that that the inflation is clearly in the single digit and core inflation components are also improving, it could cut rates very gradually. But you can see it in the table in the second line from below that why the end interest rate for 2022 is 7%, for 23 it's 6.5%. So we don't expect a short or a quick rate cut even afterwards. So we think that the interest rate environment will change partly relatively persistently.
Okay. So thank you for the further explanation. If the audience also has questions, please post your questions in the chat area, and then we'll take it one by one and try to have additional info on it. Until then, this whole context, this whole macroeconomic development, we're going to feel it again, I believe, in everything, starting for prices, but which sectors should be the most affected or most liable to feel it first?
Well, on the one, yeah, sorry. Should I reply, or because I cannot see the screen? Sorry, because I'm sharing this. Okay, so basically one part of the story is that as household income will stop increasing, we think consumer sectors and retail sales will be affected more heavily. On the other hand, probably industry could perform for a few months until the backlog. So if you look at the industrial orders in Romania, they're relatively at high level. And it's also true in Europe in general that during the COVID, we had this supply chain problems, and this meant that the order book was quite ahead of production. For example, even in Hungary, you know, if you want to buy a new car, you cannot really choose which one and which color, because then you have to wait sometimes, you know, half a year or 1 year.
Many months, yeah.
This is to normalize gradually. So until order books are normalized, industry could still grow, but in general, the slowing growth will be felt there as well. On the other hand, for example, the construction sector and the investment sector, they could benefit from the pickup of EU funds in the new budgetary period and the recovery and resilience facility.
All right. So all these indicators going up, the macroeconomic situation is worsening. What are we to expect about resources, raw materials, and everything that goes around production? Because there's a major shift now, right? From Asia trying to localize some production in Europe. Are we going to have some slowdown in deliveries and in logistics altogether? Let's say.
All product chain disruption was a major story, and we expect it to remain something which is still drag on the economies which are specialized to manufacturing. But looking ahead, we expect some improvement. And the relocation of production, well, everyone hoped that Central Eastern Europe could benefit from this because on the middle run, these product chains that were optimized, let's say, totally on costs to reach as low cost as possible. So looking ahead, other factors like control and security will be also important. So everyone hopes that Central Eastern Europe could benefit from this. However, we should tell that the lack of labor in Central Eastern Europe, that's a serious problem, also for exporters. So we will see, but the net balance could be, let's say, beneficial. I think so. So at the end of the story, we hope that there will be relocation to Central and Eastern Europe and also to Romania.
All right then. So a lot of opportunities to arise in the next times for local businesses, maybe with all this trend. And regarding interest rates altogether, how expensive will money become for local financing? Let's say in the next months. Is there a need to worry, or is there enough liquidity in the market to continue to finance local business?
Well, actually, what we think is that liquidity conditions would become tighter worldwide. So And what we can see is that interest rates on the rise. I would say that now with some fall in commodity prices in recent months, and with recession fear rising, there is a hope that rising interest rates could come to an end, or let's say to have some kind of stop, at least for a few months. But you know that we still have a strong upward trend in interest rates, and I think that we can only hope that there will be some, let's say, normalization in financing costs. But the trend is still upwards, and the outlook is not so good for those economies who have high fiscal and high external financing requirements, because those economies will feel much more about narrowing global liquidity conditions. And what we can see is that not only local currency financing costs are on the rise, but also Eurobond yields in the region are rising fast, because so far investors lost a lot on their bond exposures, and I would say that this put also more pressure on not only on local yields but also Euro financing conditions. So I would say that very likely that looking ahead, we should count with higher financing costs.
Okay, so a slowdown is on course, and maybe it will be somehow be mitigated, let's say, by the Eurozone financing with all these programs coming about.
Yeah, that's important. So European Union fund absorption should pick up, and that, well, maybe that can counterbalance somewhat on these factors.
Yeah, mitigate it somehow. But let me address another issue. We have another question here. What will happen in this specific zone, specific market of real estate? There is this trend of prices still going up, and maybe a tighter demand than it used to be half a year ago, or maybe more. Is there some danger in this zone, in this area?
Yes, definitely. The real estate sector is heavily driven by economic growth, and let's say that real estate sector has a if someone is buying the real estate, then usually he goes for a loan also. So buying the real estate calls for strong optimism, and in the last few years, both in emerging and developed economies, we have a very good environment for real estate investment, because financing costs were really low, so interest rates were low, and prices increased everywhere, demand increased everywhere. Looking ahead, with lower growth and higher financing costs, very likely demand will be more moderate. And let's say that maybe some economies could avoid more pressure on their real estate sector, but I think that in the baseline scenario, so the most likely scenario is that real estate price growth will slow down everywhere, also in Romania.
So we should expect.
May I also add something to that?
Please do, sir.
What we see currently is that quite a few savers see the real estate as an opportunity to defend against the inflation. So I see, how to say, parallel trends. And if we are talking about real estate, anyway, we have to differentiate between the different parts. So it's industrial, logistic, or these are flats, or these are commercial real estate. So what I see is that in the the era where you know our customers especially, they're still looking for flats and houses.
Okay,
so they really see that this is an opportunity to defend the value of the assets. So I think up to a certain point in Romania, there is an opportunity still that the prices still remain at least stable. And even if we feel that the prices are high, if we take it into the global comparison, the Romanian prices, real estate prices, are not extremely high. So I still believe that in certain parts of the real estate, we do not see too many problems. However, it all depends on the inflation and the increase of the rates. So if, as we heard, really we are before the topping of the inflation, so I'm quite positive that certain segments of the real estate can be a safe haven.
Okay. So we're still going to see some investments here. Let me to add one factor. So what could be also important so in Romania, the real estate price growth was not so strong as what we had in, for example, in Hungary and in many other economies. So let's say that's some good starting point. Nevertheless, slowing growth and higher financing costs are usually put pressure on real estate. But it's very important that for falling real estate prices, you would require a very strong macroeconomic shock. Usually, even in less supportive environments, real estate prices are so they start to grow if the environment is not friendly, but they are usually not falling. For falling prices, you need a strong overheat. Prices that are rose heavily above the equilibrium level and the real size huge macro shock. So I would say that let's say this is not on the table right now. So I would say that price growth could slow down. Maybe it won't keep the pace with inflation, but I would not expect falling prices in Romania. Okay, so that means no major shocks, let's say, for the next month, but definitely there's gonna be an adjustment according to our inflation and the whole context. All right then. If there aren't any more questions, let's see. So far by now we've answered everything. If not, if you would like to have another word or to close. On a more optimistic, let's say, on a more optimistic note, at least deposits will continue to rise.
Okay. So then all we know that we are in a very, very turbulent environment, and actually we are just really facing new challenges. However, I think that this is realistic, that the inflation, which is much higher than expected, will be topping soon. For sure, the inflation won't go away very, very fast, so it remains up on a higher level. However, I think the most important is that we should have a stabilization in that term, and it's been foreseen. So I'm optimistic that with the current environment, if Romania is able to leverage on the PNRR, so this stabilization and resilience funds, much higher level than we were able before. So I think that all in all, we still have a good chance to have a not too bad year for us in the upcoming 12 months. I hope that it was optimistic enough. But anyway, you know, we are here, and every quarter we updating you on the recent events, and hopefully next time it will be numbers much more favorable for you.
All right, a good realistic analysis, let's say, and with all the facts on the table, food for thought for everyone. Thank you to all our presenters today, and thank you for attending this event, everyone. We hope these insights will help you better navigate the economic developments in the next months. And of course, let's next time maybe hear about it with more optimistic economic indicators, let's say. Thank you all again, and have a great day.
Thank you. Bye-bye.
Bye-bye.
Bye.